Hello my fellow investors and welcome back to another earnings report analysis video. Today guys, I would actually like to take a look at the earnings for the company Amazon. Now I know I'm a day late on this. I'm terribly sorry for not putting out a video at 4 p.m. today, but I got home last night. I was really tired and I couldn't make a video. But today guys, I am planning on doing this one as well as a couple other ones for tomorrow. So tomorrow you guys are going to get like 3 or 4 videos in one day. So be prepared for that. So now let's actually take a look at guys the earnings for Amazon and see how they actually performed, and also let's do an analysis on their stock to see what we would like to pay for them today. So with that said, let's get started with this analysis. Alright guys, we're over here at Seeking Alpha at the latest quarterly earnings because they actually do have them updated. Very surprising. For some reason they haven't been updating the past ones that I have done. But right here we got guys the EPS normal actual. It was a beat by 8 cents, 28 cents. They were expecting 20 cents. EPS gap actual 28 cents again, and it was a beat by 7 cents. Revenue was $127.1 billion. However guys, this was actually a miss by $370 million. And looking how this company's stock responded, now this is a day later guys. Take a look at this. As of Friday 4 p.m. it ended down almost 7%, which is crazy. Now after market on Friday, they did go up a little bit by what, 0.29%, but overall guys, on the 1 year graph, almost 40% down. On the year to date, 39.31% down. The 52-week ranges is between $188.11 all the way down to $97.66. So as you can clearly see, this company was very much overvalued. And in fact, if you take a look at my other Amazon videos, please ignore the bad audio quality. I didn't have a good mic back then, but if you take a look at those Amazon videos, even before the stock split, I was saying that it was still very expensive. And now that it has fallen this much, I really am curious to see if Discounted Free Cash was telling me that it is a good buy today. But regardless guys, here we have the earnings report. Now as always, I will have this link in the description below for you guys to see. It's pretty lengthy. It is about what, 15 pages or so. Well, I'm only going to cover a few of the points that I noticed that stood out to me, but nonetheless, you guys can read it at your own time. We got here guys, net sales for Amazon increased 15% to $127.1 billion in the third quarter compared to $110.8 billion in the third quarter of 2021. So that was a pretty good increase. Excluding the $5 billion unfavorable impact from year-over-year changes in foreign exchange rates through the quarter, net sales increased 19% compared with third quarter of 2021. Now they do have it itemized here based off of the North America segment increased 20% year over year to 78.8 billion. International segment sales decreased by 5% year over year, 27.7 billion, but increased 12% excluding changes in foreign exchange rates. Pretty much is saying that because the dollar has gotten so strong, this is causing all funky stuff happening with the exchange rates. Therefore, it looks like it is a decrease of 5%, when in reality it was actually an increase of 12%. And now coming into their AWS segment, sales increased 27% year over year to $20.5 billion, which is an increase of 28% excluding the changes in foreign exchange rates. So all of this guys is kind of 50-50. However, what ended up being really bad guys is when it comes to these operating incomes as well as the free cash flows. This was really bad. Operating income decreased $2.5 billion in the third quarter compared to $4.9 billion in the third quarter of 2021. North America segment operating loss was $0.4 billion compared to 2021, which is 0.9. International segment lost again $2.5 billion compared to 0.9 billion in the third quarter of 2021, and the AWS was $5.4 billion compared with operating income of $4.9 billion in the third quarter. So this one did go up a little bit guys, but overall it was still fairly down, as you can clearly see. Now when it comes to the net income decreased to $2.9 billion in the third quarter, or 28 cents per diluted share, with $3.2 billion, 31 cents per diluted share in the third quarter of 2021. So even though they did beat on analyst estimates, overall year over year they did go down when it came to their net income. And it's actually funny too because they make it a point here that the third quarter of 2022 net income includes a pre-tax valuation gain of $1.1 billion included in non-operating income from the common stock investment of Rivian Automotive. Now, when it comes to the free cash flow, guys, this was awful. Take a look at this. Operating cash flow decreased 27% to $39.7 billion for the trailing 12 months compared to $54.7 billion for the trailing 12 months ended in September 30th, 2021. So that was a massive decrease, guys. 54.7 to 39.7, 27% decrease. And when it comes to the free cash flow, guys, it actually decreased to an outflow of $19.7 billion, meaning that they had a lot more capital expenditures than they had cash from operations. So it was actually an outflow in money. That's really bad, guys, compared with an inflow of $2.6 billion for the trailing 12 months ended in September 30th, 2021. So their cash flow, guys, completely bombed. It was awful. So as you can clearly see, Amazon did not do so good when it came to their earnings, and let's actually read a little bit of what the CEO had to say. In the past 4 months, employees across our consumer businesses have worked relentlessly to put together a compelling Prime member deal event with our 8th annual Prime Day in the new Prime Early Access sale in early October. The customer response to both events was quite positive, and it's clear that particularly during these uncertain economic times, customers appreciate Amazon's continued focus on value and convenience, said Amazon CEO. We're also encouraged by the steady progress we're making on lowering costs in our store's fulfillment network and have a set of initiatives that we are methodically working through that we believe will yield a stronger cost structure for the business moving forward. There is obviously a lot happening in the macroeconomic environment, and we'll balance our investments to be more streamlined without compromising our key long-term strategic bets. What won't change is our maniacal focus on the customer experience, and we feel confident that we're ready to deliver a great experience for customers this holiday shopping season. Guys, that was such a mouthful, it wasn't even funny. I understand what he's pretty much saying though. He's pretty much being like, we had a rough time, but you know what? We're gonna continue going with the way that we were doing it, and hopefully things will better up in the future. But in my personal opinion, guys, I do not believe that will be the case. So now, guys, let's actually do a very quick stock analysis on Amazon. We got the ticker symbol of AMZN, market cap of $1.1 trillion and a PE of 92.99, essentially 93. Guys, that's massive. Current share price of $103.41. 5-year average free cash flow, $11.3 billion. Last year's free cash flow, negative $14.7 billion. Yeah, guys, you can clearly see their free cash flow is hemorrhaging, and it's hemorrhaging hard. You can clearly even see even today with those earnings report. Looking at the net income we got 5 years ago of $3 billion to $33.4 billion, increase of 1,000%. Free cash flow, it was going pretty good from 5 to 2 years ago, and then boom, massive collapse, going from 2 years ago of almost $26 billion to negative $14.7 billion. That is a decrease of 330% from the 5-year, with an average of $11.3 billion. Revenues looking pretty good, $177.9 billion to $470 billion, increase of 164% on the 5-year. Assets minus liabilities is also increasing. Today they have $137.5 billion with an average assets minus an average liabilities of around $83.7 billion. Cash flow minus liabilities, however, it is just going deeper into the red, and that's mainly because of the fact that their cash flow is just horrendous right now. As of 1 year ago, they're at almost negative $300 billion. Average cash flow minus the average liabilities, it is negative $168 billion. And unfortunately, guys, when it comes to their shares outstanding, this is also looking very bad. On the 5-year, this is an increase of 5.35%, and even from the previous year to the current year, that is another increase around 0.1%. Every single year, guys, they have been increasing shares non-stop, very consistently increasing, actually. And the reason for this is I personally believe that they just felt that their shares were so overvalued that they just started to issue shares because it's overvalued. And lastly, when it comes to the cash equivalents, they currently hold around $35 billion with an average of $33.61 billion. So now let's come over here and make some assumptions, low, median, high, using, of course, the revenue growth and a projected share buyback assumption, and keeping a required rate of return of 10%. Now, guys, before we even move on, look at this. The target share price is not adjusting for debt. Without making any assumptions, it is $26.29. Take a look at the current share price now, $103. Yeah, guys, it needs to fall already a lot. Now, things will get better once I put in the revenue growth, but understand that this company, you know, it's a good company, but to all of those people who may say this will never fall this low, guys, it has already fallen 40% on the 1 year. Come on, like, it has already fallen. The fact that you think that it can't fall further, That's absolutely ludicrous. And by the way, that's not to everybody, but I'm saying to those people who believe that it can't fall further. Now let's actually make some assumptions, guys. For the revenue growth, let's come over here to Seeking Alpha. We can see that the forward is estimated to be 15.58%. Now, do I believe that? Actually, no. I think it's going to be a lot less. So for the low assumption, let's say 5%. For the median, let's go with 7%. And for the high one, let's go with 9%. Now for the projected share buyback, guys, they've been issuing shares at 5%. So let's actually put that as the median with negative 5%. The negative just means that they're issuing shares. Now for the low one, guys, let's say that they'll issue a little bit more shares at like negative 6% in the next 4 years. And for the high one, let's bring it down to like negative 4%. Guys, take a look at these target share prices. $29.54 to $34.53, $31.95 at the middle. That's absolutely insane. Adjusting for debt, if we take the cash and equivalents and we add the net debt, if they have more cash and debt, the number comes up. And if they have more debt than cash, the number comes down. And it comes down, guys, by around $3 or so to $26.34 to $31.26 with $28.72 in the middle. Adding a margin of safety of 5, 10, and 15%. For the lowest assumption, highest margin of safety, this puts me at $22.39. And for the highest assumption, the lowest margin of safety, we got $29.70. So overall, guys, you can clearly see it's telling me that it's still overpriced for what you are getting in this company. Now, again, to all those people who might say like, this is wrong, there's no way, you have no idea what you're doing, you don't understand growth. I love that. You don't understand growth. Guys, the first thing I have here is revenue growth assumption. I mean, it is what it is. Now, to all those people, again, who might think it'll never fall out there, guys, it has already fallen 40% on the 1 year and 39.31% on the year to date. So guys, it will fall. It has to fall based on their fundamentals. Eventually, over time, over the long term, the company's stock will follow the fundamentals. Now, if the fundamentals get better and the stock price goes up, then that's actually a good thing, right? That's actually a good thing because now the company's bringing more value to you. Understand that these numbers I have here, it is not a prediction of what the share price is going to. These values over here, it is essentially the value of the company. I'm not telling you guys that the share price is going to go to $29. No. I'm saying that the company should be worth $29 based off of these assumptions. As I always say, these assumptions, the ones that I made. If you guys don't believe this, then by all means, have this calculated for free, guys. That's the reason why I have it for free, because this is not financial advice. And every investment is the present value of all future cash flow. Make your own assumptions, guys. Have this calculator, the book value one, the reevaluation one, and a dividend tracking sheet. Make your own assumptions when it comes to Amazon, guys, and any other company. Do not follow what I am saying, because my opinion might be different than yours. Actually, my opinion will be different than yours. So it is what it is. All I'm asking for in return for free content, free calculators, is just help me grow my channel. Thank you so much for everybody who have subscribed so far. Y'all are nuts. 1,300 subscribers, 1,300 plus actually. We're up to like what, 1,326 or something like that. Absolutely insane. Thank you so much. I really do appreciate it, and it really does motivate me to make more videos like these. So all in all, guys, there is Amazon's earnings report analysis. They did horrendous. They really did bad. Not as bad as Facebook, but still, they did do pretty bad. So do with that information as you will. Obviously, the link to their earnings in the description below. And that pretty much does it for this video, everybody. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out. And I will see you all in the next stock analysis video, as well as earnings report.